Not all income requires constant effort. Some opportunities are designed to generate returns quietly, rewarding patience and smart decision-making over time. The right choices can create steady cash flow with minimal day-to-day involvement, allowing money to grow in the background while you focus on other priorities. When structured wisely, these streams can become a dependable foundation for long-term financial stability. Today, we will talk about top 5 investments that pay you passively. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Dividend stocks. Dividend stocks are one of the most time-tested ways to generate passive income while building long-term wealth. When you buy shares of dividend-paying companies, you become a partial owner of a business that shares its profits with you on a regular basis. These payments are usually distributed quarterly, though some companies pay monthly or annually. The real power of dividend investing comes from consistency and compounding. Instead of spending the dividends you receive, you can reinvest them to purchase more shares, which then generate even more dividends. Over time, this creates a snowball effect where your income grows without requiring additional work. The key is to focus on financially strong companies with a history of stable earnings and consistent dividend increases. Businesses in sectors like consumer goods, healthcare, utilities, and energy often provide reliable payouts because their products and services remain in demand regardless of economic cycles. Diversification across multiple industries reduces risk and stabilizes income. Dividend yield is important, but sustainability matters more. A high yield is meaningless if the company cannot maintain it. Long-term investors also benefit from potential share price appreciation, which increases overall net worth in addition to income. By investing regularly, holding for the long term, and reinvesting dividends, you can gradually build a portfolio that pays you passively year after year. 2. Rental real estate. Rental real estate remains one of the most powerful passive income strategies because it combines monthly cash flow with long-term appreciation. When you purchase a property and rent it out, tenants effectively help pay down your mortgage while you retain ownership of the asset. Each month, rental payments can cover mortgage costs, property taxes, maintenance, and insurance, with the remaining portion becoming profit. Over time, as property values rise and the mortgage balance decreases, your equity grows significantly. One of the major advantages of real estate is leverage. With a relatively small down payment, you can control a high-value asset. This amplifies potential returns compared to many other investments. Additionally, real estate offers tax benefits such as depreciation and expense deductions, which can increase net income. Investors can choose long-term residential rentals for stability or short-term vacation rentals for higher income potential. Hiring a property management company can reduce daily involvement, making the investment more passive. While real estate requires upfront capital and careful research, selecting properties in strong locations with high rental demand increases success rates. Over time, rental income can rise with inflation while mortgage payments remain fixed, expanding profit margins. With strategic planning, rental real estate can become a reliable income stream that pays consistently and builds long-term wealth simultaneously. 3. Index funds and ETFs. Index funds and exchange-traded funds, ETFs, offer one of the simplest and most accessible ways to generate passive income and long-term growth. These funds pool money from many investors to purchase a diversified basket of stocks or bonds that track a specific market index. Instead of attempting to pick individual winning stocks, investors gain exposure to an entire market segment, reducing risk through diversification. Many index funds distribute dividends generated by the companies they hold, providing consistent passive income. Additionally, these funds typically have low expense ratios, meaning more of your money remains invested and compounding over time. One of the greatest strengths of index investing is automation. Investors can set up recurring monthly contributions, allowing wealth to grow steadily regardless of market conditions. Over long periods, markets have historically trended upward, rewarding patient investors. The combination of capital appreciation and dividend income makes index funds a powerful dual-income vehicle. Because they require minimal management, they are ideal for individuals who want a hands-off approach. Rather than reacting emotionally to short-term market fluctuations, disciplined investors focus on long-term growth. By consistently contributing and reinvesting dividends, index funds can gradually build a substantial passive income stream while increasing overall portfolio value. 4. REITs and real estate funds. Real estate investment trusts, commonly known as REITs, provide exposure to real estate income without the need to purchase or manage physical property. REITs are companies that own or finance income-producing properties such as apartment complexes, office buildings, shopping centers, warehouses, and hospitals. By law, many REITs are required to distribute a large portion of their taxable income to shareholders as dividends, making them attractive for passive income investors. Publicly traded REITs can be bought and sold like stocks, offering liquidity and convenience. This allows investors to access real estate income streams without dealing with tenants, repairs, or property management. There are also private REITs and real estate funds that may offer different risk and return profiles. Diversification across various property sectors reduces exposure to economic shifts in any single industry. For example, industrial and logistics properties may perform differently from retail or office spaces. REITs often provide higher dividend yields compared to traditional stocks, though they may carry higher volatility. Investors seeking consistent income can allocate a portion of their portfolio to REITs to enhance cash flow. By combining dividend stocks, index funds, and REITs, investors create a diversified income-generating portfolio that balances growth and stability. 5. Digital assets and royalty income. Digital assets represent a modern and scalable approach to passive income. Unlike traditional investments that require financial capital, digital assets often require intellectual capital and creativity. Examples include writing ebooks, developing online courses, licensing photography, producing music, designing software, or creating digital templates. Once created, these assets can be sold repeatedly without additional production costs, leading to high profit margins. Online platforms automate payment processing, product delivery, and customer management, allowing creators to earn income around the clock. Royalty-based income is particularly attractive because each sale or usage generates recurring revenue. While there may be initial effort in creating and marketing the product, ongoing maintenance is typically minimal. Successful digital asset creators focus on solving specific problems for niche audiences, which increases demand and pricing power. Marketing through social media, email lists, and search engine optimization can drive long-term traffic. Over time, a portfolio of digital products can create multiple income streams that operate simultaneously. This scalability makes digital assets one of the most flexible passive income strategies available today. By combining creativity with strategic marketing, individuals can build sustainable income that continues to pay long after the initial work is completed. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.